Have you ever noticed holes in the financial markets? Like this one? Or maybe this one? That's what we call gaps. And in this lesson, we're going to break them down so you can get an edge and take better investment decision. Welcome everyone, and let's dive into this new class. First, we'll explore what gaps are and why they appear. Then, we'll analyze the breakaway gap. After that, we'll check out the runaway gap, followed by the exhaustion gap. And finally, we'll take a look at the common gap. Let's get started with the what and the why. Okay, so an up gap happens when the opening price is above the previous day's high, and the low of the day stays above that same high. For example, here, we have a gap. See this area in orange? It's the gap, which can also be called a window. A down gap follows the same concept, but in the opposite direction. It occurs when the opening price is below the previous day's low, and the high of the day remains below that low, like in this example. Now, why gaps are created? According to the efficient market hypothesis, which states that all available information is already priced into the market, gaps occur due to news announcements that happen while the market is closed. So, when the market reopens, prices instantly adjust to reflect the new information, without any trades taking place in the gap. For example, earnings reports from companies can create gaps. The same goes for macroeconomic indicators, presidential speeches, and other major news events. Let's move over to TradingView to check out Amazon's stock price. For example, here, we have a huge gap, and we can see that it lines up with an earnings report for this period. We can imagine that financial report was not very good for Amazon, and this led to a fall in prices. In fact, earnings were good, but revenues down almost 700 million on forecasts. Revenues are more important than earnings, which explains this drop. Now, look at this gap I'm highlighting here. It was also during financial report. If I click on the earnings report, everything is a good surprise, directing prices upwards. Let's look at another example with Toyota Motor Corporation. Do you remember when Trump first announced he was going to impose tariffs at the border? That decision had a big impact on exports to the US, and Toyota was one of the companies affected. For instance, if we look at the first weekend of February 2025, when the announcement was made, we can see a huge gap right here. This was directly caused by Donald Trump's speech. Okay, let's now talk about the breakaway gap. A breakaway gap occurs when the gap breaks a key support or resistance level. As we can see in this picture, there's a support zone right here, and a down gap that breaks through it. This breakdown is confirmed by high trading volume, making it a strong signal. This is a triple signal to be short here. First, the down gap itself is a bearish signal. Then, the price breaking through a support level is a short signal too. Finally, the high trading volume confirms the strength of the move, making it a reliable indication of a short signal. Let's analyze Apple on the daily chart. We can see that there is a support level right here and a strong resistance zone above. During this period, the price is consolidating in a range, and then we see a gap forming just here. It breaks through the resistance level. So this is a breakaway gap which confirms the breakout. The breakout of the resistance is a signal to go long. The breakaway gap also. On top of that, the increase in volume provides further confirmation, making this breakout even stronger. This combination makes it a very bullish signal, meaning we can confidently open a long position. And we see that the price rises sharply. Okay, let's now see the runaway gap. This type of gap confirms the trend and is caused by increasing interest in the stock. In this example, we can see that we were in an uptrend, and then a huge gap appears, accompanied by high trading volume. This is a runaway gap because after it forms, the trend continues in the same direction. Runaway gaps usually appear after a breakaway gap, confirming strong momentum. When traders spot this kind of gap, they should follow the direction of the trend and trade accordingly. Okay, let's analyze NVIDIA and see how it was possible to predict a strong move. First, we can see a breakaway gap right here. This gap breaks through a resistance level, signaling the start of an uptrend. After this little consolidation and volume confirmation. After that, the price rises, and we notice another gap forming. Since this new gap appears after an initial breakout and within an ongoing uptrend, it is likely a runaway gap. Plus, we see that volume confirms. At this point, we could have placed a long position here, expecting the trend to continue. And in fact, the price does keep rising. This runaway gap would have been a good entry point. We are now going to look at the exhaustion gap. This type of gap comes after a strong move in one direction, signaling the end of the trend, a loss of momentum, and a likely reversal. In this picture, we can see that the trend started with a breakaway gap, followed by a runaway gap, and the price moved sharply upward. In fact, it increased by around plus 60% in just 4 months. Toward the end of this strong trend, a new gap appears, which is an exhaustion gap. Right after this, the price drops sharply and the trend reversed. Exhaustion gaps typically occur after a runaway gap, and if the price has gained plus 50% to plus 100% in less than a year, the next gap is very likely to be an exhaustion gap. Okay, let's analyze Robinhood stock. We can see a strong resistance level here, which has been tested multiple times. At this point, there is a clear breakout, and we can spot a gap, which created this breakout. It is confirmed by an increase in volume. Since it appears right after the breakout, this is a breakaway gap. Now, let's analyze what happens next. The price rises, and another gap forms, again confirmed by volume. This indicates a runaway gap, confirming the strength of the uptrend. The price continues its upward move, but at this level, a new gap appears, but without significant volume confirmation. Since volume doesn't strongly support it, I don't think it qualifies as another runaway gap. The trend continues, and at this level, we see a huge gap. This gap is strongly confirmed by the volume. Now, let's take a step back and evaluate whether this could be another runaway gap or an exhaustion gap. Measuring the entire movement from the beginning of the trend, we see that the stock has gained almost plus 150% in less than 4 months. Given how sharp the trend has been, in such a short time, it's most likely an exhaustion gap, meaning a reversal is imminent. To trade this, we could place a short position entry below the low of this candle, set a stop loss just above the high, and target a take profit level around this strong support zone. And as we can see, our take profit is successfully hit. Okay, let's now talk about the common gap. This type of gap occurs routinely or are common. It is very frequent in trading. Unlike other gaps, common gaps are not tradable, as they do not signal strong price movements or trend changes. For example, in this picture, we can see the S&P 500, and we can spot several gaps. Many of them are not linked to any major news events and are not confirmed by volume. This is especially common in ETF, as their prices adjust based on movements in foreign markets during US market closures. Okay, let's take a quick look at Nokia Corporation stock on TradingView. For example, we can see a small gap here with no volume confirmation. And the same happens just here with, again, no volume confirmation. There are a lot of common gaps on this stock, like here and here, where there is neither volume confirmation nor any news event. These gaps are not tradable. Now, let's focus on this larger gap. It stands out because it is confirmed by a significant increase in volume. Looking closer, we see that this gap aligns with a financial report, earnings and revenue announcements, which were positive as we can see. As a result, the stock jumped in value. This gap is a breakaway gap which breaks the January consolidation. There is another gap here, with no volume confirmation, so it's a common gap. And so on, we can see many common gaps in this stock. Okay, let's wrap up this class with a quick conclusion. First, we looked at breakaway gaps, which break out of a range and mark the start of a new trend. Then, we covered runaway gaps, which occur after a breakaway gap and confirm the continuation of the trend. After that, we analyzed exhaustion gaps, which appear after a strong move and signal a potential trend reversal. Finally, we discussed common gaps, which are frequent but lack volume or news confirmation, making them non-tradable. Thank you all for joining me. I hope you found this class valuable, and I'll see you in the next one.